We've seen it happen again and again. Stocks soar, everyone feels like a genius, then suddenly panic takes over. Why do smart, rational people repeatedly get swept into market bubbles, even when history has already shown us how those stories usually end?
Because investing isn't just about numbers, it's about human nature. The biggest mistake people make is believing bubbles are created by markets. They're actually created by emotions. Every bubble begins with a believable story, grows through optimism, accelerates with greed, and ends with fear. The technology changes, the companies change, but human psychology barely does.
So the charts are really reflecting our emotions?
Exactly. Think of the market as an emotional mirror. Prices don't only reflect business performance, they reflect hope, fear, confidence, and uncertainty. That's why behavioral finance is just as important as reading financial statements. Most people imagine they'll stay calm during a boom, but once they see friends making money effortlessly, something changes.
FOMO?
That's the turning point. Fear of missing out is incredibly powerful because it feels logical. Your neighbor doubles their investment. Social media celebrates overnight millionaires. News headlines predict a new era. Suddenly, staying disciplined feels like making a mistake. That's where herd mentality quietly replaces independent thinking.
History seems full of those moments.
Absolutely. Tulip Mania, the dot-com bubble, the 2008 housing boom, Bitcoin's explosive rallies, and even today's excitement around artificial intelligence all followed familiar emotional patterns. The assets were different, but the emotional cycle was nearly identical. First comes disbelief, then optimism, excitement, euphoria, anxiety, denial, panic, and finally despair. Most investors don't lose money because they picked bad assets. They lose money because they bought emotions instead of value.
That's a powerful way to put it.
Here's what surprises many people. Bubbles rarely feel like bubbles while you're inside them. They feel like obvious opportunities. That's why overconfidence becomes dangerous. During rising markets, success is often mistaken for skill. People begin ignoring risk because recent wins convince them they're smarter than they really are.
So what separates disciplined investors from emotional investors?
Disciplined investors build systems before emotions arrive. They decide their investment strategy, risk tolerance, and long-term goals when they're calm, not when markets are exciting or terrifying. They understand that wealth building is usually boring. Emotional investing chases headlines. Long-term investing quietly compounds over decades.
If viewers remember only one lesson from today's conversation, what should it be?
Remember this, markets move in cycles, but human emotions move in patterns. Whenever everyone believes prices can only go higher, pause. Whenever fear convinces everyone the market is finished, pause again. Your greatest investment advantage isn't predicting the future, it's mastering your own psychology.
That's the perfect reminder. Markets will always fluctuate, but emotional discipline never goes out of style. If this conversation changed how you think about investing, like the video, subscribe for more insights into the psychology of investing, and share it with someone building long-term wealth. We'll see you in the next episode.